Welcome to Shares from the American College of Financial Services. Here's a look at what we'll be sharing with you today.
We think it's investor friendly. We think it's individual friendly. It's not for everyone, but we think it's going to be a fun, just one more arrow in the toolkit of how to manage investments so you can continue to have a reasonable allocation, diversified portfolio, and not let the kind of tax decision be the tail that wags the dog.
Hi, I'm Eric Ludwig. I'm Director of the Retirement Income Certified Professional, or RICP designation, and Director of the American College Center for Retirement Income. I'll be your host for this conversation on retirement income and planning. And I'm joined today by Meb Faber. He's a co-founder and chief investment officer at Cambria Investment Management. Cambria is a leading quantitative asset management firm headquartered in beautiful Manhattan Beach, California. So Meb, welcome to the podcast and thanks for sharing your knowledge with us today.
Great to be here. Thanks for having me.
I have to say I've been a fanboy of you for several years. And what I wanted to start with is your background, because it's probably not the typical route into finance. It looks like you double majored in engineering science and biology, maybe took some time off to ski bum, as I understand, and then made your way into the investment world. So how did that all happen? What led you from sort of the science-based start to into investments?
Very deliberate, preordained path. Like most of us, it's a windy road. We often joke and look back at the tiny decisions we made in our 20s that seemed like little nudges at the time, and often decisions that were made for us. I think as many entrepreneurs can relate, probably somewhat totally unemployable as a young man. And I think the 20-year-old version of Meb could definitely learn a thing or two from the middle-aged version of Meb. And so, I think much like in the world of investing, much of people's path in life is influenced by their geography, just the time, the regime they existed in, what's going on in the world. I still very much am, interested in genetics and the whole biotech world and engineering, which was kind of my undergrad and grad school. But the hobby became a career and vice versa. The financial markets, as you know, are endlessly fascinating, never a dull day. And so, it's just one of those career paths where it started out as a little wedge and then a year became two and a decade became two. And here we are.
I've heard somebody refer to you as the backtesting king in like a bad way. And you're like, wait a minute, that's not a bad thing. That's a cool thing. So I'm curious, do you remember sort of how you got started in that? Like, was that something back in your college days or?
So, I cut my teeth during my favorite bubble, which was the late 90s internet period, which had some rhymes with the 2021 period where, the retail investment world became enamored with financial markets. Often financial markets tend to be somewhat of a sideshow whirring in the background that people don't pay that much attention to. But certainly with the late 90s, my professors were trading stocks in class, right? And if you know anything about engineers and doctors, they're always the worst investors. I love you guys, but they're super smart, overconfident, and love to fiddle. And that was the case back then too. But I think looking back on that period, I made all the mistakes. And the best thing a young investor can do is make a ton of mistakes because you get the scars, which later inform you when you hopefully have a lot more money, not to make those dumb mistakes again. And I think so many people are afraid of making mistakes, not just in investing markets, but in life. If you participate in social media, everyone is an amazing trader. No one has any losses. But one of my favorite investing quotes, that Mark Yusko, my buddy, talks about a lot. He says, every trade makes you richer or wiser, but never both. And what do we mean from that is like, you make a great investment. Do you learn anything from that? You probably learn the opposite. You learn that you're brilliant and you have a high batting average and you're never going to make losing trades. And, you knew it from the beginning. You knew that NVIDIA was a winner from the beginning. But, I think the losers really teach you a lot more about markets. And so my period, post 2000, almost everybody, got creamed. That was a bear market that if you invested in internet stocks and also as a biotech bubble too, I was working for a biotech mutual fund and I don't know, the stocks went down probably 60, 80, 90%. And so to me, that was almost like a puzzle that I really wanted to figure out, like how could this happen? And then you start to study history, which the back testing, is more about are you a student of history and do you start to appreciate just how weird and fascinating financial markets have been? Because most of the time people get surprised in markets. Most of the time it's already happened before. You look at Russia, essentially going to zero. Well, they've shut down their capital markets before, so that's not necessarily something that should have surprised people. And markets, normal market returns are extreme. Very rarely do stock markets go up like 8% every year. Usually it's up 30, down 5, flat, up, on and on. So I think appreciation for history gives you the foundational base from then which to work from. But most people, the extent of their history studies with financial markets is their own lived experience. And so, if you cut your teeth like I did, late 90s, early 2000s global financial crisis would be very different than someone who graduated college in 1980 or 1940 or 1900, on and on. And not only just in the US, but in other countries. And if you were born in Japan, started investing in 1990, very different than if you were born in China or the UK or Greece. So I think trying to understand the myriad spectrum of outcomes hopefully helps us become better prepared to survive these financial markets, which is really the number one thing. Is like, can you reach your goals? Can you get to the finish line? And the volatility and uncertainty that's always involved in financial markets makes that a really hard path for many of us, because at the end of the day, we're human.
Yeah, absolutely. I know I've seen you write on this too, that like, why do the markets go up and down? And I think this was maybe on Josh Brown's show that you had talked about, why do markets go up and down? Well, because there's people trading stocks, right? I don't know if you want to expand on that, but
Well, yeah, I mean, look, we all have a neighbor who probably told you to buy some Dogecoin or said, I got this great investment. And coin flip, it's probably going to be bad, but maybe they made a bunch of money and then they say, I knew it, I told you. Anything worse than someone saying I was right, but also I told you. It's like being right squared, right? So I think that's the challenge, is the supermarket choice of how many investments you can probably make. Everyone feels like they have to have an opinion on everything. Tesla, what's going on with the Fed or gold, on and on. It's endless. And so I think it's a challenge where most investors we talk to, getting to the point where you have a written investing approach. Listeners, ask yourself, do I have a written plan? And 90% of you are going to say no. I know, because we consistently ask and no one does. And the problem with that is, for anyone who's listening who's ever been on a diet or who's ever had some sort of, program you're trying to adhere to, if you're just winging it, it's a lot harder. Because if you wake up in the middle of the night and you go get some ice cream, hey, that's not written as part of not being part of the plan. Or, hey, I'm just going to go get that donut with my coffee in the morning. But if you have a plan, it at least gives you the foundation from which to work from. And as a even keel sort of spot to go back to. Anyway, but that's a first step, and nobody does. And the reason that's such a problem is, for those of you who have a garage, you can walk out to your garage. And if you don't have a garage, walk into your closet and take a look around and look at all the ridiculous stuff in there that you have an emotional attachment to. And that's true with investing too. Like, there's no way you're ever going to wear those corduroy pants again, or that leather jacket from when you were 20. Or if you're in your garage, there's that lawnmower that doesn't work, that just needs a spark plug, but you don't get rid of it. And it's the same thing with, our investments. And so thinking in terms of having a plan and a blank slate, I think, is a useful thought experiment, especially as we get down into year end, as a time for renewal and reviewing kind of what's going on in your life. Same is true with portfolio too.
that makes sense. I mean, I feel like I have some similarities to you in the sense that I started as in the investment world anyways, in like August of 2007. So like my first 18 months on the job as an advisor anyways, was during that financial crisis. And I mean, a lot of investors didn't know what to do. Clients surely didn't know what to do. Planners didn't really know what to recommend other than just to try to buy or to hold on. But I remember, so for me anyways, I remember like it was really a spark of like trying to learn more about how people behaved and then sort of what to do about it, even from a portfolio perspective. And I remember coming across this paper called A Quantitative Approach to Tactical Asset Allocation on the SSRN. And it really inspired me, and it resonated with a lot of things that you're mentioning, like having a written plan, having sort of rules-based ways to make decisions on this. And I, to some extent, coming from the airline world, we did everything by standard operating procedure, right? So I think it really resonated me. What do you think inspired some of that research into the tactical asset allocation, and why do you think it resonated with people so widely?
Well, you mentioned like an airplane pilot having a checklist. Like checklist is such a great way to think about financial markets too, because it probably would eliminate many of the boneheaded decisions we all make. And so having a plan and writing it down, there's a million ways to succeed as an investor. And you can be someone who just invests in stocks. You could be somebody who does a globally diversified portfolio, on and on. You could be a tactical trader. All could be successful. I think that the challenge is, most of us have the temptation to kind of shift and just work from our emotions, which is really hard when it comes to money. I joke about this paper. I was in my 20s when I wrote this. It was my first academic paper. And like many of us, I'm at my most productive when trying to avoid doing something else. You don't want to clean the house. You may do 20 other things to avoid doing that. And it was true for me in this case too, because I was working on a designation, which was the technical version of the CFA called the CMT. And they used to have a test. And I, being a strong willed 20 something year old, didn't want to take the test. And so they had a paper requirement where you could write a paper. But then they announced they were doing away with the paper at the end of the year. So I think I submitted an abstract on like December 31st. And I didn't even know what I wanted to write about. I just said, a simple approach to market timing, which was the original name of the paper. And market timing has a lot of baggage in our world for people. And so no one would actually read it once I did write it. And so then I changed it to the much more consultant sounding title that you mentioned, which sounded a lot more sophisticated and buttoned down and professional. But, that paper, unlike a lot of academic papers, I think was meant to be readable and simple. It also helped a lot that it came out pre-financial crisis. So it was a methodology that really would have helped investors during the financial crisis. I think if it came out afterwards, people would have probably not found it as compelling. But it's nothing that we invented or was new. These ideas, almost every investing idea has been around for 100 years, whether it's buy and hold investing, value investing, trend following. All of these have been around for quite some time. This was just more of a modern, simplistic spin on it. And again, as the older I get, the more I have an appreciation for what is the narrative we tell ourselves and our clients that help us to continue on. And buy and hold, as you mentioned, fantastic investing strategy. The biggest Achilles heel for buy and hold is it has a high correlation to what's going on in the real world, meaning traditionally when it's hitting the fan, so think 08, 09 or the Great Depression, the financial assets traditionally do poorly too. And so you think about it, if you're in a recession or a depression or you're losing your job and companies going under and unemployment skyrocketing, you don't really want your portfolio to also be going down. If you zoom out, it doesn't matter because on periods of 10, 20 years, these portfolios should do really well. But in the short term, how many investors did you talk to, did I talk to that in 2009 said, I sold everything, I couldn't take it anymore. And then they may not have got back in until 2010, 2012, 2015, 2018. And, that's a shame. And the paper that we wrote was more of a tactical approach, a trend following approach. which would have done totally fine during 08, 09. The problem with that strategy is it has its own challenges, where the two big ones are you have to actually go and place the trades or have someone do it for you or have a fund do it for you. Or second would be that you underperform your buddy who is crushing it in the S&P, which, by the way, since 2009 has compounded at 15% per year. So going full circle back to our earlier part of the discussion, if you started investing in 2009, 10, 11, you would think 15% returns are normal. Like that's what you expect going forward and forever. If you study history, you realize that's a lot higher than average. And so, having the knowledge that, hey, pat yourself on the back, appreciate these returns, but at the same time think, okay, this may not be the standard for which I should set my goals and expectations for the rest of my life.
Absolutely, yeah.
As the baby boomer retirement wave crests, it's time to position yourself as the ideal partner for this growing pool of clients with the American College of Financial Services Retirement Income Certified Professional designation. As an RICP, you'll get the specialized knowledge to help more clients with complex retirement planning needs. With the convenience and flexibility of the latest in e-learning design, the RICP delivers applied knowledge from over 45 retirement experts on Social Security, taxation, income planning, Medicare and Medicaid, long-term care planning, and more. Get started in our 3-course program today and become an RICP in 12 months or less. Now is the time to strengthen your client relationships with deep expertise to address the unique challenges of retirement. See how you can expand your opportunities at theamericancollege.edu/RICP.
I just saw something on LinkedIn where I can't remember which company did it, but they had this visual that shows like this is like the top, bottom left to top right line at compounding at whatever return, and this is like what the market does, and it showed how long it sort of underperformed the compounded line before it met back up with it. And it's like, oh yeah, those are the kind of visuals that are helpful. It's like, yeah, there's going to be lengths of time where investors either way are underperforming.
The really sophisticated technical term for this is the good times often follow the bad and vice versa, right? So if you look at like a 10-year rolling returns for US stocks going back 100 years, there's been 4 periods where they've compounded 15% plus for a decade. And usually they all have names, right? There was the roaring 20s of 100 years ago. There was the nifty 50 stock period in the 1960s. So it's kind of like our parents' generation or grandparents' generation, Mag 7 of today. You had the internet boom and kind of bubble. And then whatever this meme stock COVID period, whatever we're going to call it, AI boom, looking back on it, doesn't mean it has to end, doesn't mean it has to crash. But on average, the good times don't last forever. Like they can't mathematically. So the good times set the stage for the times that are a little subpar. That's how averages work, right? Like to get a 10% average, probably half the time you're going to be below that number as well as above it too.
Yeah, I like that's a good way to explain it. There's one thing, Meb, I really wanted to ask about. There's 2 big things that I'm going to start with this first one, and it's on this idea of dividend investing as a strategy. So a lot of, either if it's advisors or individual investors, we hear about them using this as a strategy, but I wanted to get into your research on this idea of shareholder yield, because I think it's an area where you've set yourself apart. And, most people think of dividends as this primary way that companies distribute value to their shareholders, but you've taken a broader view. So could you explain sort of what this shareholder yield is and how it might differ from the traditional dividend approach, and why does it matter?
Yeah, investors love dividends. One of the key parts about dividends, they're a major contributor to total returns over time. But I think most investors don't realize you have to reinvest those dividends to achieve the total return. So if you're using them and spending them, which is totally fine, by the way, you can do that, but realize you're not going to get 10%, you're going to get like 4. Because if you're spending the dividends on pina coladas and trips to Cabo, you're not putting that money to work. And as you mentioned, at a 10% rate of return, you 10x your money in 25 years and you 100x your money in 50 years. So if you got a kid graduating college and you fund them with a $10,000 brokerage account, by the time they retire, that's going to be $1 million. But they can't spend it along the way, right? That's the challenge in this. So, look, dividends, whether a company pays a dividend or not, historically is somewhat irrelevant. That's the way a company returns cash to shareholders one way. But what's increasingly occurred in the United States over the past 30 years is companies have been distributing cash to shareholders in a more flexible way and arguably a more tax efficient way, which is through stock buybacks. And so the shareholder yield comment is looking at the holistic combination of the two. The nice thing about the buyback equation is it also includes share issuance. So a lot of companies, particularly in the tech sector in my home state, love to give the C-suite and founders and CEO stock-based compensation that is massive numbers. And so that dilutes shareholders. The whole point of this is you should be somewhat agnostic, but if you own a stock and you believe it to be cheap relative to its intrinsic value, which is really the only reason you should own the stock in the first place, then you want a company to be buying back shares because you're buying $1 for 80 cents. Nobody talks about this more than Warren Buffett. Buffett has been writing about this almost every year in his letters, but really back to the 1980s, talking about stock buybacks is a great way for a company to return cash to shareholders and take advantage of undervalued stock. Buffett himself says, hey, I'll buy back stock in Berkshire when it's down around 1.3 times book value. And he's done a lot of that in the last 5 years, although he's been fueling up his plane to Japan quite a bit recently. So he's been buying some foreign stocks too. And Berkshire famously has never paid a dividend. He jokes that the only time he did in the early days of Berkshire, he must have been in the bathroom when the board decided to pay one. Because the problem with a dividend is if you're a taxable investor, you have to pay taxes on the dividend. Whereas a buyback, you can say, I'm not selling my shares, and then you own a bigger part of the company. So the shareholder yield concept is a book we wrote a decade ago. That book is now going to be in its second edition this month. So investors, you can go grab one on Amazon, or hopefully we'll have the digital version for free on our website, either at my blog, Meb Faber, or over on Cambria Investments. But this is an investment strategy that ends up being a very Buffett-esque style where, for a company to be paying out 10% of its cash flows or market cap in dividends and buybacks, you have to have the cash flows in the first place, which means on average, you're going to be probably a quality company. And we run some screens, say, look, we want to be value stocks, paying down debt, on and on, but really gets you to a portfolio of companies where these value investments are trading at one of the most attractive spreads relative to the broad S&P in as far back as we can measure them. And so part of that is just because the S&P has gone up so much and the big companies tend to be more expensive. And part of it is the value stocks look very attractive relative to the overall market today. So we think it's a great time to be an investor in U.S. stocks, maybe just not so much in the S&P 500 and other broad-based indices.
Well, for those of you that can see the video version of this, you'll see Meb's logo on his hat, which I told him I'm super jealous of. It's super cool. If you're looking for a ticker, there it is. That's what I love about you and your company is you guys keep coming out with these interesting ideas, and it goes from research into sort of something that an advisor or an investor can actually use. This is probably the coolest thing that I've heard of in the investment world in a long time. And it's about an upcoming ETF that you guys have. I think it's launching in December of 24 called Tax, which is a great name. And I thought I would try to figure out how to set this question up. But, a lot of advisors anyways are going to be familiar with like a 1031 exchange or a 1035 exchange. But what the heck is this 351 exchange and why is it important in this context?
You're getting a little wonky, but we'll dive in pretty quick. Everyone hates taxes, right? And I think it's your duty as a citizen to pay every cent of the taxes you own, but also your duty as a family member, individual, community member to not pay more than that. And no one I've met voluntarily pays extra tax payments to the government. You can, and they'll take it. But if you look at investments, a lot of people have had these big gains over the past 15 years, particularly in U.S. stocks. But also, there's people who have invested in Microsoft or Amazon since the 90s, or GE, or Walmart, or Costco, and they don't sell these companies and diversify because they're like, I can't. I'm stuck in this. The tax man will kill me. And you mentioned 1031, which real estate investors have enjoyed for over a century, where you can swap one property for another, and it's not a taxable event. Well, we've eventually, come to understand, and there's been 100 of these already, so it's not really our innovation, but you've seen these sort of mutual fund to ETF conversions. You've seen a couple investment advisors pick up their asset management business and convert it to ETF, and neither of these are taxable transactions or conversions. Our hopeful innovation is, we say, why does this have to be limited to rich people? Let's do open enrollment for everyone. So if you want to continue, if you want to seed this new ETF or contribute your portfolio, and there's some rules around it, like it can't just be one stock. It's got to be a diversified portfolio. So the top 5 holdings have to be at least 50% and under. Top holding can't be over 25%. So if you got 100 million in GameStop, sorry, Roaring Kitty, you can't contribute that. But in general, you'll contribute this to a fund. We plan on a series of at least 3 funds doing this. The first you mentioned will be tax, and you can email us and get more information. This is our first time working through this process, so we want to make sure we get it right. We have over 150,000 investors, so that's a lot of paperwork if everyone decides they want to opt into this first one. But it's a cool idea. We think it's investor friendly. We think it's individual friendly. It's not for everyone, but we think it's going to be a fun, just one more arrow in the toolkit of how to manage investments, so you can continue to have a reasonable allocation, diversified portfolio, and not let the kind of tax decision be the tail that wags the dog.
So, Meb, does that end up being like, so if let's say an investor has an SMA or whatever, so it meets that diversified part, there's lots of gains in it, and then they are allowed to sort of move it within the ETF wrapper. Is their basis now based on what the sort of the share price was of the ETF?
So it doesn't magically wash the gains. That would be illegal. So let's say you bought Amazon at IPO, so your cost basis is like 1 penny or whatever it is, and then you move it over to the ETF. You now have an ETF, ticker symbol is tax, but the cost basis is the Amazon cost basis. But the beauty is, because of the efficiency of the ETF, A, you have a diversified portfolio, and B, despite the turnover in the ETF, you should, on average, have no capital gain distributions. If you look at SPY, it hasn't had a capital gain distribution since 1997. Since the inception is what I'm saying. And so, this gives you the ability to maintain a diversified portfolio. And then one day when you sell the fund, hopefully in 2090 or 3010, then you would pay taxes on the capital gains of that portfolio.
Okay, that makes sense. Even from like the different positions in the fund, is that where the different issuances come out? Like if you have different stocks from different portfolios that end up in the fund, is that kind of how that works?
Well, no. So a historical exchange fund works like that. The problem with the historical exchange funds, they're only available to rich investors, so accredited or qualified. You got to hold them for 7 years. They usually charge an arm and a leg. It's like 1.5% a year. Ours is going to be 49 basis points. And then you end up with a portfolio of the stocks people contributed. An ETF is just whatever the strategy may be. So our first fund is a long only stock fund. Our second fund is a diversified ETF global portfolio. And then our third fund is a diversified global stock portfolio. So you'll have this menu to choose from on what you want the eventual strategy to be. So yes, people will contribute varied investments. They can contribute ETFs too, and then end up with whatever the strategy of the fund has been. You've seen in this type of conversion last year alone, I think it was 100 billion in assets that have moved. Most of it has been like one fund structure to another, like a mutual fund to an ETF. But we're saying, hey, this should be available to everyone. So we're going to try to do it with, it's a lot of family offices, a lot of advisors managing for their own clients. But we expect there to be individual investors too.
Yeah, it's a fascinating approach. I'm excited for you guys to
That goes to show you're one of my people, one of the nerds like me to find tax code fascinating and tactical asset allocation. There's not too many of us out in the world.
Yeah, absolutely. Well, hopefully after the show there will be more. I wanted to wrap up with just a couple more little rapid fire ones. The one is, like we were just talking about in the investment world, there's of course different things to invest in, like stocks and this and that. But I was curious, do you have a favorite investment? And this could be a stock, could be something like investment related, or it could be money or time or relationships. Is there something that sticks out to you of something that you're thankful that you've invested in?
The older I get, the more I appreciate, and we're working on a book that hopefully will be out next summer on this topic of simply compounding in time. This concept of a young person being a time billionaire, where you have this really long runway ahead of you, and who knows, with AI and technology, you may live to 150. But the way compounding works is just getting money. Like, we talk so much in depth in investing world about styles and strategies and investments, but really the decision to save and invest in the first place trumps all other decisions. So putting money to work as young as possible and as much as possible, and still enjoying life. You don't have to live on beans and rice, but really getting it to work is a much bigger decision than on what the Fed's going to do, what gold is going to do. Just getting money working for you and compounding is the decision that gets the whole flywheel started.
I love that. Yep. Start young. Well, this has been fantastic, Mab. What is the best place for people to keep up to date with what you're working on? I know you mentioned a couple of them earlier.
Not too many Mebs in the world, so usually I'll show up if you Google my name. But we have a podcast, we have a blog. Both are Meb Faber. My day job is at Cambria, so Cambria Funds or CambriaInvestments.com for the ETFs. You can watch me, behave on Twitter, and I'm told I'm on YouTube and TikTok and other places. So just about everywhere you can find our research and ideas.
That sounds great. The other thing that I'll mention is Idea Farm. I know I get the email weekly and I love it. It's like one of my favorite things that I look forward to on Saturdays or Sundays.
Yeah, weekly email. Listeners sign up for free. Goes out to over 100,000 people once a week. Email on Sunday. I don't write it anymore, so I look forward to it with my coffee and Barron's. It's gives you the top 2 or 3 reads per week, the top 2 or 3 podcasts, and a handful of about 6 to 10 really interesting investing links and charts. It's a lot of fun. Ideafarm.com.
That's cool. Well, now, thank you again for taking the time today. I really appreciate you being on the show.
It's been a blast.
That's all for now, but you can find all our episodes on YouTube, Apple Podcasts, Spotify, and most other streaming services. Be sure to like us, follow us, and leave us a rating and review. Shares is a production of the American College of Financial Services, and we hope you join us next time as we share ideas that expand your opportunities.